everyone, this is Ricey and welcome to my channel, The Quest for Wealth. In this video, I want to share with you my method of stock valuations and the thought process that comes with this method whenever I look at the financials of a company. And if you shall watch it or this video until the very end, I will share with you a crib sheet. A crib sheet is a concise and quick set of notes which you can follow to evaluate a certain stock. And with all that being said, let's get on to it. The company has got 3 financial statements that are necessary for you to look at. These are the balance sheet, the income statement, and the cash flow statement.
Let us have a look at the Royal Bank of Canada. The first financial statement that we will have a look at is the income statement. Is the profit or loss of the company determined by taking all revenues and subtracting all expenses from both operating and non-operating activity. There are 3 major categories that you have to look at. First one is the revenue, which is also known as the top line, and then the net income, which is the bottom line. So the revenue is the income that the company generates, and then everything, all the expenses of the company is deducted from the revenue, such as the cost of goods sold, the operating expenses. All of these expenses are deducted from the revenue, and therefore you come up with the net income. So what we will do now is horizontal analysis. When we say horizontal analysis, we will compare the performance of the company to itself from year to year. So in this case, if we compare 2016 to 2017 all the way to 2020, we can see here that the revenue of the company has been growing steadily. We also want to see the steady growth of the net income here from 2016 to 2020. As you can see here, it is also growing. Now, I have recorded these figures in an Excel file. Let us do the horizontal analysis. Formula is we take the current year, subtract the prior year, and divide it on the prior year. There you go. So let's carry that over here, and that is the revenue. Horizontal analysis, current year minus prior year over prior year over prior year. From 2020 until 2016, the company's revenue grew by barely grew in 2016 as compared to 2015, but it grew double digits in 2017 as compared to 2016. And it did not grow. As a matter of fact, it lost money in 2020. Now, with the growth that we see here, we want to see this growth trickle down to the net income. So the net income in 2016 actually depleted, although the company grew by 0.19%. The net income depleted, or they lost money. The company lost money in 2016, and in 2018, the net income actually grew as well together with the revenue. But then in 2019, although the company grew at almost 14%, the net income only grew by almost 3%. And then in 2020, and the net income is even lower than 11%. It's actually 14% here. This net income essentially will have an effect on the earnings per share. The earnings per share measures the amount of company's net income available for payment to the holders of its common stock. Therefore, earnings per share is what a shareholder could potentially receive per share from the company. Earnings per share has always been positive. If you will see here from 2015, it actually grew from 5.44, 5.13 to 5.83. I also recorded this in an Excel file. So our earnings per share here, in 2016, the earnings per share actually depleted, but then it grew very slowly. And let's do this in percentage points here. 13%, and then 2018 it grew again, and then in 2020 it lost value. by 14%. This is a huge drop here. In dollar value, it's not a lot, but then if you own a lot of shares of RBC, the difference could make so much difference, really. So this is how we do the horizontal analysis of the company. Now, let us do the vertical analysis of the company. How much is the net income compared to the revenue of the company? So how we do that is that we divide the net income over the revenue of the company, and that is 18%. This means that the net income of the company is 18% of the revenue of the company, and the rest were actually spent. 21%, almost 22% is the value of the net income of the company compared to its revenue. And the same with 2017, that's 22% as well. This is quite consistent somehow, it's double digits. The balance sheet identifies the total assets and the total liabilities of the company. Therefore, what it means is that if the company sold all of its assets and paid off all of its debts, all of its liabilities, the shareholder equity is what's left. The shareholder equity is the net worth of the company. There are three major figures that we have to understand in the balance sheet: the total assets of the company, and the total liabilities of the company, and of course the shareholder equity. These are the three major factors that you have to look for in a balance sheet. So let's do the horizontal analysis of the balance sheet again. So let us do the current year minus the prior year over the prior year. The total assets here says essentially that the assets of the company grew from 2015 to 2016 by 3%. And 4% in 2017, and in 2018 it grew tremendously by 12%, 4% in 2019, and 12% in 2020. This is the growth of the assets, and assets are everything: long-term investments, the capital expenditures such as the plant and equipments, everything that you could possibly put your hands on, the cash, the receivables, the inventory, and everything else. These are all here. So the assets of the company of Royal Bank of Canada grew at this much. And this is what we want to see. We wanted to see growth in the assets of the company. And then, in the same manner, the liabilities of the company also grew. If you will see here, the liability of the company grew at the same pace as the assets of the company. If you will have a look here. So in 2016, the assets grew by 3%, but the liability grew as well by 3%. And the same in 2017. It grew, the assets grew by 4%, and the liabilities grew by 4% as well. So there is consistency in the growth of the total assets and total liabilities. Now, that is all okay because there is consistency. What we do not want to see is that the total assets do not grow, but then the liabilities grow. Shareholder equity grew from 5% to 9% in 2018, and then it grew very little in 2019, but then it grew to 3% in 2020. So this is also a good sign because the growth is consistent with the growth of the total assets. Let us do the vertical analysis of these figures then. We want to see how much in percentage term is the value of the shareholder equity as compared to its assets, and that is 5%. So we do this and there is consistency. The shareholder equity is actually growing as well. In 2016 it grew by 6%, it further grew by 6%, and another 6% in 2018 and 2019, and 5% in 2020. So there is consistency in the growth of the shareholder equity. A cash flow statement reports a company's major sources and uses of cash during a certain period of time. It reports the revenues earned and the expenses incurred by the company, and therefore these are all the money coming in and out of the company. The very first figure that you will see here is the net income, profit and loss, and this comes from the income statement. The last figure in the income statement is the very first figure you will see. So remember that all of these are reported in millions of US dollars, and therefore the reason for that is that shave off many zeros. So we have to take a look at the three main cash flow resources of the company, which are the cash flow from operating activities. These are the daily operations of the company. Cash flow from investing activities. So if the company takes its money and invests it on a different kind of company, this is what we get, or the company should earn from it. And then the cash flow from financial activities. Financial activities is essentially the borrowings of the company. What we want to see is that the cash flow from operating activities should be higher than the net income. So in this case, the cash flow from operating activities of the company is predominantly higher than the net income. You will see here the cash flow from operating activities of Royal Bank of Canada is at 19,461,680,000. So if you will have a look here, it's only at 8 billion for the net income, so that is more than double. For the cash flow in the investing activities, what's quite interesting here is that the company is actually losing money on its investing activities, and it's losing money on a consistent basis. In 2015, it lost 20 billion, and then again in 2016, another loss in 2017. It actually did never recuperate in its investing activities cash flow. It consistently lost money, and even with the cash flow from financial activities. Now, if you will look here, the cash flow of the company for the financial activities are actually negative. That means that the company had to borrow money. The main point here is that the cash flow, the net cash flow, should be positive. This is an important factor, because if it is negative, then the company is not earning anything. It is absolutely bleeding cash. And in 2015, the company lost money. The net cash of the company was negative. And then it revamped in 2016, and it grew in 2017. But in 2019, it actually lost money again. But then the amount of money, or the amount of cash flow, it increased. It's more than 68 times in 2020. Now I had put this in an Excel file. Company lost 147%, but then it grew by staggering almost 500% in 2017, but then lost in 20. The net cash flow is negative. The net cash flow is negative. Therefore, there are more money going out of the company than coming in. By 86%, even worse. In 2019, by 308%. 2020, the net cash flow of the Royal Bank of Canada grew by 2,048%. This is staggering, from losing in 2019 to gaining in 2020. This is also a red flag because of the fact that it is not consistent. Consistency is a key in any company that we want to evaluate. The point is, looking back, we want to see consistency, and for the net cash flow, this is quite inconsistent. Now, as I promised, beginning of this video, that I will share with you a crib sheet or a cheat sheet. This sheet will quickly evaluate a stock, and these ratios, all of these ratios are available on Yahoo Finance, Macro Trends, and Morningstar. The first one in the crib sheet is the book value per share. Ideally, what we want to see is to be equal or higher than the stock price. Revenue per share is the second one. Revenue per share is the top line of the company divided by the outstanding shares. The earnings per share is the bottom line. The earnings per share is the company's net profit divided by the number of common shares. Return on equity and return on invested capital. These numbers, we want to see this grow over time. Dividend growth. To me personally, I look for companies that provide 3 and above dividend yield. The debt ratio. Now, the debt ratio should be equal, the maximum, equal to 5 years of the company's earnings. Of course, the PE ratio. PE ratio is the price to earnings ratio. Generally these days, the acceptable PE ratio is 15 and below.
Thank you very much indeed. I hope this video was of value to you. If you gained value in this video, please like, share, and subscribe. And I will see you in the next video.